Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about PAYCHEX INC quarterly report. PAYCHEX Inc. offers a wide range of human capital management (HCM) solutions for small to medium-sized businesses. These include payroll processing services, employee benefits administration, human resources, support insurance services, property and casualty, health and life, workforce management solutions, talent acquisition and management services, retirement solutions, benefits administration solutions, digital marketplace for earned wages and financial wellness, voluntary lifestyle, benefits payroll solutions, calculation, preparation and delivery of employee payroll checks, regulatory compliance, services. The company markets its services primarily through a direct sales force. The recent decline in PAYCHEX Inc.'s stock price can be attributed to several factors. The company's Q4 2025 earnings report, which met analyst expectations but provided mixed guidance for the next fiscal year, contributed to a 10% drop in its stock price. Additionally, concerns about a cooling labor market and uncertainties surrounding new business trends led analysts to adjust their price targets downward, with some firms assigning underweight ratings to the stock. The integration of Paycor, which was acquired by PAYCHEX, has also been perceived as slow, adding to investor skepticism. Furthermore, Cone and Qtwo fiscal year 2026 results have not provided significant relief, with analysts continuing to cut earnings forecasts and trim price targets. The overall negative analyst sentiment, coupled with the company's mixed performance, has resulted in a stock price drop exceeding -14.97% over the past year. The primary drivers of revenue growth or decline are multifaceted. On the growth side, management solutions have been a significant contributor, with a 21% increase due to expanded client base and Paycor acquisition, contributing an additional 17%. PEO and insurance solutions also saw increases, driven by growth in average worksite employees and insurance revenues. Interest on funds held for clients has also played a crucial role, with 51% and 38% increases attributed to higher investment balances and realized gains. Core business revenue grew by 19%, while non-core business revenue surged by 126%. The integration of Paycor was another key factor in revenue growth. On the decline side, compensation-related expenses increased due to an increase in headcount, while PEO direct insurance costs rose with growth in average worksite employees and insurance revenues. Net income and profit margins decline. A shift in company performance. The company's net income has experienced a decline of 7.3% overall, with more significant drops observed in the 3 and 6 months ended November 2025, decreasing by 4% and 7%, respectively. This downward trend is also reflected in profit margins. Operating income margin decreased from 41.7% to 37.1% in Q3 2025, while net income as a percentage of revenue dropped from 31.4% to 25.3% for the 3 months ended November 30, 2025. The 6-month period saw an even more substantial decline, with operating margin decreasing from 41.2% to 36%. These changes suggest that the company's profitability has been impacted by various factors, leading to a decrease in both net income and profit margins. The company has consistently demonstrated a strong ability to generate positive operating cash flow, with reported amounts of $1,234.5 million and $1,163.3 million. This indicates that the business is capable of producing sufficient funds from its core operations to support its financial obligations and investments. The consistency of these figures across multiple pages suggests a reliable trend in the company's financial performance. The company's debt level and interest expenses have undergone notable changes over the past period. The total debt has increased by 17% from $2,563 million to $2,995 million within 6 months. This growth is accompanied by a significant rise in interest expenses, with an increase of $59 million in Qtwo and $117.6 million in Hone. Additionally, the weighted average interest rate for the PNC credit facility has been 4.48% as of November 30, 2025. These changes indicate that the company's financial obligations have become more substantial, potentially impacting its overall profitability. Management's outlook on company strategy. The company's outlook is driven by strategic initiatives, including the integration of Paycor HCM Inc., which has led to increased expenses but also growth in revenue. The acquisition aims to enhance capabilities in the upmarket segment and expand AI-driven HCM solutions. Key focus areas include growing the client base through investing in sales, marketing, and leading-edge technology. Management anticipates that corporate cash and credit facilities will support business operations for the foreseeable future. However, they may need to adjust capital spending if operating cash flows are reduced due to risk factors such as interest rate increases. The company is exposed to interest rate risk through recurring credit facilities, which could impact earnings if interest rates rise. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In 2025, it paid out $777 million in dividends and also utilized its authorization to purchase shares worth up to $400 million, with the majority of cash being allocated towards share repurchases. That concludes the financial summary for PAYCHEX INC. Feel free to comment below, and I will be happy to answer them when possible.